It should be free from any bias. It should be neutral, must be complete, free from error, right? So faithful representation makes information reliable to the users. So that is our next. Enhancing qualities. Number one, enhancing quality, comparability. So you present those financial information like that, that should be comparable. Like I told you, both companies, Toyota and the Ford companies, they belong to automobile company. So their financial information comes and that should be comparable. It means you are comparing apple to apple. So accounting information capable of being compared with information from other companies in the same period. What do we mean by verifiability? Which means information capable of being checked for accuracy, completeness, and reliability. Reliability will come from faithful representation. Verifiability, it means if someone want to verify that whether you have a plant in the North America or not, whether the value you return is the same value or not, they can be confirmed. If not confirmed, it means you commit a fraud or it's an offense, it's a crime, and your company would be got some penalty, and that penalty is not like in thousand. So you heard that these kind of news that okay, Apple company got sued for $10 million, $100 million, right? Why? Because if you make a crime, commit some kind of embezzlement in figures or something, it is a crime or a fraud, and you have to pay hefty amount for that one, right? So verifiability should be there. Timeliness. It's not like that. This is 2021 is going on, and now you are publishing your record, and that belongs to 2015. 2015 record is going to be published in 2021. No. Every year you need to publish that one, and that should be timeliness as well. So information made available to users early enough to help them to make decisions. Or in 2020 data you are publishing in June 2021. This is not timely. Why? Because 2020 is going to be the year going to be ended at 31st of December, and you took 6 months, half of the year, to publish your 2020 data, which is also not timeliness. You can take 1 month, okay, January, because you need to verify there is the audit going on, the accountants need to verify the stuff, and then you publishing takes time. Okay, 30 days enough, but 180 days or 6 months is not timeliness, right? Understandability. You don't use the words that are not familiar to the accounting language. Don't use other words. For example, if in accounting the word is profit and you are using the word return, you can use profit or income. Okay, return in sense it is the same stuff, or in your own language some other kind of return. So that is confusing, or markup or something, right? Or increase in value. So no, use those words which is very understandable and it persists in accounting language. For example, the word profit is also going to be used or in America in automobile industry, in food industry, in can industry, in beverage industry. It's the same one, understandable. So information sufficiently transparent so that it makes sense to reasonably inform users of the information. Right, guys? So it should be standardized, understandable by potential investors, lender, or creditor as well. Right? So you and I, who wants to invest in Coca-Cola, in Ford Motors or in L'Oreal, makeup industry, or in someone else, something else. So we can just look at their financial information because we can understand that because profit is going to be included in all three financial statements. And now we can compare and then we can invest, we can buy their shares, right? It should be understandable. Cost constraints, right? Cost constraint, which means cost of disclosure should not exceed the expected benefits to the users. Which means if you have a small business or small company, but making those financial statements, your profit is 20,000, but making these financial statements costs you 25,000. Then if you make those financial statements, then you're rather having a profit, you will be having a 5,000 loss. So remember that one. If you're not a big company, then don't hire professional accountants because then you need to give them higher salaries or it's like that. So the frameworks or the conceptual framework should be that the information should be relevant, faithfulness, and then timeliness, this kind of stuff, the other qualitative stuff. They should be bounded by the cost. Cost should be less than, and the information that you provide, the benefits outweigh the cost. It's like that, right? If this is not fulfilled, then what's the point of giving the accounting information to the public at the cost when the cost is high, right? So that constitute the financial reporting standards. So the assumptions and principles. Number one is the entity assumption, which is the organization stands apart from other organizations and individuals as a separate economic entity, which means the owners and the company, in the eyes of law, they are two persons, right? Like I told you, the company can buy its property under its own name, not under the name of its owners. If I buy the shares of Apple Corporation, it doesn't mean that I own the Apple head office, some part of like its land or something. No, the land belonged to Apple Corporation. In the eyes of law, it is a separate entity. Continuity or going concern, it means the owners can die, company don't die. So you heard that the life of the companies, for example, the Coca-Cola industry is more than 130 years old. The Nestle company is more than 150 years old. So those who basically set up the companies, they are dead, but company is still there, right? So it means entity will remain in operation for the foreseeable future. So there is no end life of the company. Company is going, a person can die, owners can die, so they can transfer their ownership. Owners can be different, but company don't have the specified life, right? Going concern means that the end life, or we cannot assume that company will, for example, stay in business for 5 years. After that, company will die. No. Going concern means company can be operated for foreseeable future. Why? Because it's easy to transfer the ownership. Owners can change, but company cannot be changed. Like we know that the Steve Jobs died, but Apple is the same. The company name is not changed. Apple is the same. Now this is Tim Cook. When Tim Cook resign or some other person will come take over the companies, like that. So this is called continuity or going concern. Historical cost principle. It means assets, or if the company bought the property or a building, it should be recorded at the cost. For example, company bought the property in 1990s. Now this is 2021. That building, they bought it for $1 million. But now the worth is more than 2 billion. So assets must be recorded on historical cost principles. Right? You bought it in 1990. That's it. Under the financial information, that building should be of $1 million, not $2 billion. Number fourth assumption in principle is that stable monetary unit assumption, which means effect of inflation is ignored based on assumption that dollar's purchasing power is relatively stable. Or if you can say that one year you use dollar to present your financial statements, other years you are using yen, other years you are using euro, right? These kind of stuff is not recommended. Plus, you remove the effect of inflation, right? Any question, guys? Let's take a 5 minutes break and then we start again. Please do tell me if there is any question. So I'm going to be pause recording and then we will start after the short break. Okay, guys, welcome back after a short break. So regarding the IFRS, this is just for information. You can pause the video and read it by yourself. Okay, so our third learning objective, which is a little bit more objective, which is apply the accounting equation to the business organizations. Let's talk about this. So the accounting of the business is, accounting equation of the business is assets is equal to liabilities plus honors equity. We'll talk about the assets, liabilities, and honors equity. What does it mean? But right now, just remember that financial statements are based on the accounting equation. And what is the accounting equation? Assets is equal to liabilities plus honors equity. So left hand side must be equal to right hand side. All right. So if the left hand side is 1000, the right hand side must be equal to 1000. So you see, liabilities are 600, honors equity are 400, right? And it must be equal. So there is no approximation sign or